Commercial banking plays a crucial role in the financial system by providing a wide range of financial services to individuals, businesses, and governments. The functions and regulations governing commercial banking are essential to ensure the stability, integrity, and efficiency of the banking sector. Here is a detailed overview of the functions and regulations of commercial banking. Accepting deposits. Commercial banks accept various types of deposits from customers. Current accounts are typically used for daily transactions, while savings accounts offer interest on deposited funds. Fixed deposits provide higher interest rates for a fixed period, and recurring deposits allow customers to save a fixed amount regularly. Providing loans and advances, commercial banks extend credit to individuals and businesses. Personal loans are offered for various purposes like education, medical expenses, or purchasing consumer goods. Home loans enable individuals to buy properties, while business loans cater to the financing needs of enterprises. Working capital finance helps businesses manage their day-to-day operations, while project finance supports large-scale projects. Credit creation. When commercial banks issue loans, they effectively create money. This is because they do not need to hold 100% of their deposits as reserves but are required to maintain a certain percentage as mandated by central banks. By lending out a portion of deposits, banks expand the money supply, promoting economic growth. Offering payment services, commercial banks facilitate payments between individuals, businesses, and institutions. They provide services like check clearing, enabling the transfer of funds from one account to another. Electronic fund transfers allow customers to send money electronically, while wire transfers facilitate international transfers. Debit and credit cards enable convenient and secure transactions, and online banking platforms allow customers to manage their accounts and make payments digitally. Providing trade financing. Commercial banks play a crucial role in facilitating international trade by offering trade finance services. They issue letters of credit, which assure exporters of payment upon meeting specified conditions. Banks also provide guarantees to ensure the fulfillment of contractual obligations. Trade financing instruments such as export-import financing and trade loans help businesses manage cash flow during the trade process. Managing foreign exchange. Banks provide foreign exchange services to individuals and businesses. They facilitate the conversion of one currency into another, enabling international trade and travel. Banks also offer hedging instruments like forward contracts and options, allowing customers to manage foreign exchange rate risks. Moreover, they engage in currency trading to profit from fluctuations in exchange rates. Investment banking activities. Some commercial banks engage in investment banking activities. This includes underwriting securities, such as stocks and bonds, assisting companies in raising capital through initial public offerings, IPOs, or debt issuances. Banks also offer advisory services for mergers and acquisitions, asset management, and capital market transactions. Regulations of commercial banking. Capital adequacy. Regulators establish capital adequacy requirements to ensure banks have sufficient capital to absorb losses and maintain financial stability. These requirements, such as Basel III norms, set minimum capital ratios based on risk-weighted assets. Banks must maintain capital levels above these thresholds to safeguard depositors and the banking system from potential failures. Prudential regulations. Prudential regulations focus on risk management, asset quality, liquidity management, and governance. Banks are required to have robust risk management systems to identify, assess, and mitigate various risks, such as credit risk, market risk, and operational risk. Asset quality regulations mandate banks to maintain a certain level of non-performing assets and provision adequately for potential loan losses. Liquidity regulations ensure banks have sufficient liquid assets to meet their obligations. Governance regulations emphasize the role of the board of directors and executive management in ensuring effective oversight, transparency, and accountability. Anti-money laundering, AML, and Know Your Customer, KYC AML and KYC regulations aim to prevent banks from being used for money laundering, terrorist financing, and other illicit activities. Banks are required to implement robust customer identification procedures, conduct due diligence on customers, and monitor transactions for suspicious activities. They must report any suspicious transactions to the appropriate regulatory authorities and cooperate with law enforcement agencies. Consumer protection regulations protect the rights of bank customers and ensure fair practices. Banks are required to provide clear and transparent information about their products and services, including terms and conditions, fees, and interest rates. They must address customer complaints promptly and fairly. Regulatory bodies may establish ombudsman schemes or dispute resolution mechanisms to resolve conflicts between banks and customers. Data privacy and security. Banks must comply with data privacy and security regulations to protect customer information. They are required to implement robust security measures to prevent unauthorized access, data breaches, and cyber attacks. Banks must obtain customer consent for collecting and using their data, and they must adhere to data protection laws that govern the storage, processing, and sharing of personal information. Market conduct and competition. Regulatory authorities promote fair competition and prevent anti-competitive practices in the banking sector. They monitor market conduct to ensure banks do not engage in unfair or deceptive practices that may harm customers or hinder competition. Authorities may impose penalties for violations of competition laws, such as price fixing or market manipulation. Supervision and oversight. Regulatory bodies supervise and oversee commercial banks to ensure compliance with regulations, assess financial stability, and monitor risk management practices. They conduct regular inspections, review financial statements, and stress test banks' resilience to adverse scenarios. Regulatory authorities have the power to intervene, impose sanctions, or take corrective measures if banks fail to meet regulatory requirements or pose systemic risks. These functions and regulations collectively form the framework for commercial banking, ensuring the safety, integrity, and efficiency of the banking system while supporting economic growth and financial inclusion.